Australian iron ore miner Fortescue has reported a 41% drop in full-year net profit against a backdrop of sluggish Chinese steel demand and falling iron prices. Bloomberg's Paul Allen joins us now with more on this. And Paul, not such great numbers, but were there other key takeaways and perhaps even bright spots?
Well, for Fortescue, I mean, its only product is iron ore at the moment, and its biggest customer is China by far. So it's uniquely exposed to what goes on in that market, and we're seeing that reflected in the headline numbers. As you say, a huge drop in net profit. $3.37 billion was the takeaway, but the dividend suffered as well. That's down about 30%, and Fortescue paying its lowest dividend in about 7 years. So Fortescue did reduce costs. It did have record iron ore shipments, but none of that was enough to offset the weaker iron ore price. And I mentioned Fortescue is trying to diversify. It's getting into energy, into hydrogen as well, and it's made some huge investments there, about $3 billion over the past 4 years or so, but so far no return on that investment. We did hear from the Fortescue Energy CEO Gus Pichot. He says green energy, green hydrogen does remain key to the future, but for now the results not too good, and we're seeing that reflected in the share price today. Fortescue's off about 2.5% at the moment.
And we're getting towards the end of earnings season in Australia, of course. What have the results looked like so far?
Yeah, well, not bad, but then again, expectations were somewhat giddy heading into this, and valuations were pretty high as well. If we take a look at some of the case studies from this Commonwealth Bank, it's the largest company by far on the index, makes up about 10% of the ASX index by weight. I mean, cash profit did meet expectations there, but analysts didn't like the outlook, especially in a falling rate environment, and it dropped 6% on the day, and it's still about 4% down from where it was 2 weeks ago. CSL is another market darling that underperformed in a couple of key sectors and saw its steepest ever share price drop. So companies that miss are getting punished very badly. Guzman and Gomez, the Mexican fast food chain, got punished. The building supplies manufacturer James Hardie got hit as well. But to give you some context, and we'll get some more on this in a moment, the ASX has been at record highs, so anything less than a stellar performance does tend to get punished. So for a little bit more on that, let's get to our guest, Elfreda Jonker, Client Portfolio Manager and Investment Specialist at Alphinity Investment Management. And Elfreda, thanks for coming in.
Pleasure, Paul.
And I do want to start on that point. I mean, the market is just so unforgiving when it comes to misses. Is that because the results have been disappointing, or the expectations have just been so high?
Yes, I think it's probably a bit of a combination of two. And if you look at the overall market level, it's now trading at a price-to-earnings ratio of 20 times forward, relative to the long-term average of 15. So what the valuation tells you is really just the amount of risk that you take when you enter into a position currently. So expectations coming in have been very high, particularly for stocks like a CBA that you've mentioned. So there's just not a lot of appetite for any company that's either going to miss a little bit or guide lower than what the market expected. So that's why you've seen those big moves, and it's very similar to what we've seen in the global earnings season, actually. A lot of big daily moves on that side as well.
Well, we do have the index hovering around record highs. So when you put together what you've just described, does that suggest that a correction is on the horizon?
It definitely feels like we're at the point where we need to see earnings growth come through. I think if you look at the current expectations, the market is expecting now another negative 2 to 3% for 2025. And that would be the third year of negative earnings growth for the Australian market. If you compare it to other markets where we still see strong earnings upgrades, it does pose the question, you know, why would you want to be in Australia if you can get earnings growth elsewhere, and why do you pay up for it here? We don't want to make an overarching call on the market direction. What we are doing is to go bottom up and really look for those idiosyncratic earnings stories, rather than trying to call the market overall or any specific sector for that matter.
What are some of the idiosyncratic stories that you like at the moment, especially when it comes to different sectors in the Australian economy, and perhaps some of that influence also coming from Chinese demand as well?
Yeah, so currently we are actually quite underweight the miners. I think if you look at that sort of Fortescue results that you've just mentioned, we are not necessarily convinced yet that we've seen enough demand-supply fundamentals improve to dramatically increase our materials section. So where we are still positioned quite a bit is in some of the insurance companies, particularly those focused on domestic, like a Suncorp. But we are acknowledging that we're probably at the end of that sort of pricing increase cycle for insurance. Two standout companies that I can mention, just looking at other sectors. So within the technology sector, we really like Technology One. They continue to come through with really strong results, really strong product and new innovation coming through with additional growth angles, particularly in the UK, in councils and education. So something like a Technology One for us is still one where we expect to see earnings growth and particularly positive earnings revisions, which is what we look at. And then in the healthcare space, another example would be ResMed. The healthcare sector has been in a world of pain this year globally, but ResMed is one of those companies that continue to do really well because they have very strong balance sheet. They can continue to not just give us additional buybacks as well as dividends, but they actually have a fantastic product pipeline where they can still gain market share. So it's companies like that that we continue to see potential upside in.
Are you factoring in another potential 25 basis point rate cut from the Reserve Bank, and how would that change your thinking of asset allocation at the moment?
Yeah, I think we definitely are probably of the opinion that if you look at the overall market, what the market's expecting is another 1 to 2%, 1 to 2 interest rate cuts over the next 12 months. And for us, all the indications are there that we probably should expect interest rates to go lower from here. One area that we are specifically looking at and where we have been quite underweight has been the consumer. And that is where we're starting to see a few green shoots picking up, not just from a macro perspective, but also from the recent results. So that is one area where we would be increasing our exposure, where consumers can benefit from that lower interest rate outlook going forward.
As we head into this lower interest rate environment, how does that influence your view around financials as well? Because we might see some pressure on net interest margins. What do you like there?
Yeah, I think generally speaking, we've actually had quite a bit of exposure in the banks over the last sort of 12 to 18 months, and it's really helped us a lot, and it's because they've had the positive earnings revisions. We continue to see that, and as a result, we're still there, but we have been reducing, and we are underweight the banks. We are selectively positioned in NAB and Westpac as our two preferred, with CBA, a fantastic company, but very expensive. So we continue to sort of reduce those positions in banks as well as insurance with the outlook of lower rates ahead, and rather moving towards sectors such as real estate that can benefit from the lower rates.